Hi, everyone. This is Jason Breck of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. We're recording this interview on Monday, October 27th, 2025. The S&P 500's rallied a lot lately. It's over $6,700. Despite all the crazy stuff going on in the macro conditions with Trump tariffs, it's been a weak dollar for a lot of 2025, although the dollar index has rallied a little bit lately. The gold and silver price got smashed today on news of a potential China trade deal. Today's special guest is a returning guest. They wrote a book a couple years ago. It came out, I think, in August of 2023 called Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. They also are one of the top macro experts with their newsletter. Lyn Alden, thank you for joining me again.
Thanks for having me back. Happy to be here.
So, Lyn, I talked about some of the asset price inflation, and I would argue, we've had a lot of asset price inflation for years now. Despite all this, why do you think President Trump, Scott Bessent, why do you think they're so adamant that there needs to be interest rate cuts rapidly in the near future?
Well, I would separate people in the administration from the Fed. I think the people in the administration, they generally want higher asset prices, despite the fact that asset prices are already good, and they probably want stimulatory effects on the economy. They pretty much said as much. Now, there's been some of that for example, in the prior administration, although Biden himself was pretty tight on it. Like Elizabeth Warren, for example, grilled Jerome Powell on high interest rate policy during that time. So it's generally the case that those in power would prefer more dovish policy when possible. Some of them tend to have a little bit more respect for the independence of the Fed. So at least optically, they will be kind of light on criticism or on specific statements like that, whereas obviously Trump is generally disregarding of social norms, and so they have more of a policy both in his first term and here in the second term of being more direct about their kind of desires for more dovish monetary policy. Some of the people in administration that then try to articulate kind of in more detail what Trump is saying will generally argue things like that they believe that their policies will be disinflationary, and that the Fed is maybe behind the curve and that they should be more forward looking. That'd be their words in many cases. Now, for the Fed themselves, they are also somewhat dovish. So they're not as adamantly dovish as the administration is, but they do have penciled in gradual rate cuts over the next year or so. I think their arguments are primarily around that the slight weakening of the labor market, in their view, seems to be taking precedence over the fact that inflation, as they measure it, is still pretty sticky and high above their target.
Now, do you think the Fed's inflation target has changed? Because for many years, they had a 2% inflation target. I remember Janet Yellen talking when she was Fed chairman, not Treasury Secretary, about how they couldn't get their 2% inflation target, even though I would argue the real inflation rate was higher than 2%, but the Fed said with their official CPI that it was below. So do you think that the Fed now realizes that basically inflation is not fully going to go away and that they're gonna allow maybe a 3% annualized inflation target? Do you think that's like the new normal that the Fed people at the Fed have?
So I mean, they haven't officially changed their target. I do think that they are more fine with something like a 3% level, the way they measure it. Um, I think the bigger issue, perhaps, is that they're realizing that their tools are not that suitable for addressing this type of inflation, which I've talked about before, which is, if you go back to the 70s, uh, most of the broad money supply creation that was happening at the time was from bank lending. And so raising rates dramatically could slow down bank lending and therefore directly tackle the key source of at least the demand side of inflation. Obviously, there's also the oil component on the supply side. Whereas here, over the past, call it 5, 6 years, it's primarily been fiscal spending that's been the driver of at least the demand side of inflation, and there really hasn't been that many supply side issues outside of kind of 2022 timeframe. Um, and and most of it's not bank lending. So bank lending is at a totally kind of low to mid level, is pretty subdued. They've had that kind of compressed for years now. They've got weak PMIs, so both manufacturing and service PMIs are pretty weak. Prices paid for both manufacturing and service PMI are up despite weak activity, which is rare, and that's largely because of tariffs. And so when the Fed looks at kind of things that they have some degree of control over or influencing, they basically say like our portion's been done, and there's nothing they can do about the fiscal deficits. And then ironically, by keeping interest rates high, they actually add to fiscal deficits through the interest rate channel. And so that's the problem with fiscal dominance is that when you have high public debts and public deficits, and it's pretty entrenched due to like demographics and kind of multi-decade policy decisions, the central bank find itself kind of trapped where, they could raise 100 basis points, they could cut 100 basis points, and it's actually, I think, not going to massively affect inflation either way because it's mostly that fiscal side, as well as other things, tariffs, and that's also part of the fiscal side.
Well, Keynes used to call that what cost push inflation, but stagflation, I mean, the Keynesians of the 1970s, the labor economists, they thought that stagflation was not possible, right? Because they thought that the only way inflation could occur was with there was wage growth. But that proved the 1970s stagflation proved that you could have inflation increasing without wage growth.
Yeah, I mean, if you funnel deficits to other areas besides wage increases going up, you can basically cause all this extra demand for things. I mean, basically, as money flows out toward Social Security, Medicare, defense, and interest expense, all that expense is someone else's income. Often through multiple chains of intermediaries. So even like, employees in the healthcare sector, employees in the defense sector, all the people on Social Security, all the people that are receiving more interest expense than they would, interest income for them than they would if interest rates were material lower. So that is, getting out into both the domestic and to some extent the global economy, and has kind of a demand side inflationary component at a time when also on our supply side, I mean, so a lot of our system is designed around structural deflation from the productive sense. So, for example, we had a 30-year stretch of pretty rapid globalization. The China opened up to the world, the Soviet Union collapsed, and so all of this Eastern labor and resources connected with Western capital, and so you had this really kind of long period of excess supply, disinflationary growth, and the cost of all that was a few things. One is fragility. The more you globalize supply chains, in many cases, the more fragile you make them. And two, obviously, there are winners and losers from that. So we've deindustrialized the United States. We've kind of pushed our industry elsewhere. That's kind of the cost of it's kind of whole Triffin's dilemma, being the global reserve currency. It's been, we get to exert our will in the world, but we gradually hollow ourselves out industrially. And after many decades of that, we're not really any more globalizing. Now, arguably, we're going backwards in globalization now. But even if we're just going flat, even if we're no longer in a period of rapid globalization, we've taken out that supply side, while the large deficits are still pushing on the demand side. So it's natural that many prices in many categories are above their target.
Well, to add to your points there, also, I think another reason that inflation is stubbornly high, why the Fed is wondering why inflation won't come down, is because of the weakness in the dollar for 2025. Yes, we've had a rally in the dollar lately, the last 6 to 8 weeks, but overall for 2025, I mean, the dollar has been very, very weak for the first 9 months of the year. That was one of the worst starts in 30 or 40 years.
Yeah, in rate of change terms, it's been very weak. It's been stabilizing somewhat more recently. It's still pretty overvalued on a trade basis. It's still in its higher band, like on its kind of a multi-decade trend. It had kind of three really big bull cycles and two really big bear cycles. We're still in that elevated state that we've been in ever since 2015. Or so, late 2014, we're still in that kind of that higher band, even though we're obviously way off the highs. But that weaker dollar so far has around the margins been inflationary. Now with oil as cheap as it is, I don't think the dollar is necessarily like the main component here. Um, Obviously, if the dollar was stronger, we would have probably many parts of the global economy and parts of the domestic economy would be slower, and that could have a disinflationary effect. But generally speaking, when you get a weaker dollar, one of the ways that can come out is these, much higher oil prices, which hasn't really been materializing because, there's demand weaknesses. There's at least at the moment fairly abundant supply. Um, and so I'd say more of it has to do with the size of the deficits, as well as there's still some degree of post-COVID stimulus working its way through the system. Prices take, years to adjust over time as that kind of money just kind of trickles out into the system. So there's still prices kind of catching up to the growth of money supply, and that is now much diminished.
Now, I know you've studied financial history. You've talked a lot in the past interviews with me and in your books about the 1940s, the 1970s stagflation. You tend to side that a lot of the stuff happening now is more similar to the 1940s after the 1929 crash and the Great Depression era, and I think after World War II ended. But historically speaking, are a lot these budget deficits, when countries run these budget deficits, are these normally in the long run very inflationary, like stagflation, currency debasement types of events? Because I see that a lot of the deflation people just talk about, like, oh, mountain bike prices are collapsing. Those expensive bikes, the consumer can't afford the credit for the big ticket items. We're seeing subprime auto loan defaults. So where do you side with like all the distortions here, and then like some of these consumer discretionary items, people either can't get credit, can't get loans that they're defaulting, versus like budget deficits being inflationary?
But yeah, there are always multiple components. I would characterize ourselves as similar to the 1940s, with a key difference being that we're more like the UK in the 1940s than the US in the 1940s. Because at the time, the US was a rising power with a trade surplus. The UK was the incumbent power with the global reserve currency, but a trade deficit. Um, so the United States is kind of in that sort of position. And it's not the numbers as a percentage of GDP aren't as extreme as the 1940s, but the main comparison there is that unlike the 70s, when people think of inflation, they often think of the 70s, but again, that was bank lending driven inflation primarily, plus the whole geopolitical oil issue. Whereas the 1940s was a very fiscal driven inflation. So the main thing that this whole era, the 2020s, pretty much wherever you look in the developed world, has in common with the 40s is that fiscal driven inflation component. That's the biggest factor. Now, when it comes to what extent are monetized fiscal deficits going to drive up actual prices of things, that depends on then many other variables from there. So that whenever you have a large increase in the money supply, you're very likely to get pretty broad aggregate price increases as well. The offsetting factor of that is, I mean, if you get a huge ramp up in supply for something, then the money supply growth won't necessarily translate into much higher prices for specifically those abundant things. It generally will still drive up prices for the scarce things. So if you double the money supply, but then you double the supply of most commodities, it's still the case that, for example, waterfront property is probably going to go up quite a bit in price because that certainly hasn't, increase in supply dramatically as the money supply has. So you'll get that very kind of heterogeneous effect on what things are going up in price and what things are not. And then right now, the U.S. has, and this is also actually quite different from the 40s. Most of the stimulus in the 40s, at least a lot of it, kind of was injected into the working and middle class. The Rosie the Riveter type of folk, the returning vets, they got all the mortgage backup and stuff like that. Whereas here, the fiscal deficits are kind of more top heavy. They're more injected into the older
Corporate
American.
bailouts.
Well, corporate bailouts, older Americans, interest expense flowing to generally wealthy individuals and institutions, healthcare and defense spending, which goes to corporations and then generally goes to their upper middle class employees on average. So it's spilling more into that kind of the higher brackets. Um, uh, and uh, and then of course it depends on what sector you're in. If you're in commercial real estate, if you're um, if you if your income is tied to the volume of residential real estate, even the prices are holding up in many cases reasonably well. It's the volume's obviously very poor. Uh, uh, private equity, private credit. I mean, these areas are pretty stressed. The lower income consumer is pretty stressed, and so certain products or services that are bought by distressed types of sectors, people in certain areas, especially if they also don't have any supply constraints, can certainly go down. Even though you have fiscal driven inflation. So if you take a niche thing like an expensive mountain bike, and I'm not an expert on the mountain biking industry, so I don't know what any sort of
Well, and
cyclical or seasonal trends there, but yeah, you have these pockets of weakness. I've been somewhat tracking it because I'm working on a book right now. Book sales this year are not great, and there's a lot of industry people asking why, and it could be because around the margins, lower income people are trying to save their income where they can, and just cutting down on books is one of the possible categories.
Well, I mean, those mountain bikes are big ticket items. So that's like going and buying an 8K flat screen TV, the top of the line or top of the
Yeah.
line video gaming computer, or a brand new car. I mean, those are big ticket items. And in this environment where interest rates are not coming down yet, I mean, the consumer has a much higher cost of capital than someone who's more affluent.
Yeah, that's true. Now, mountain
But
bikes, I assume, well, it depends on how high end of a mountain bike we're talking about. So if it's a mountain bike bought by, on average, a middle income or a lower income group, I would not be surprised if those are down. If the mountain bikes are purchased by in this, in the higher income brackets, and if they're still down, that'd be interesting. It depends on what industry or so forth. But the point is, manufactured goods on average have a lot of supply flexibility. That's why when it comes to looking at price inflation compared to the growth of money supply, one really has to look at aggregates. Where is scarcity? So, there's scarcity in providing healthcare services. There's scarcity in gold. There's scarcity in, high quality waterfront real estate. There's scarcity um, in, many things like that. There's on average less scarcity in things like textiles, electronics, manufactured goods, unless of course we talk about niche things, which are increasingly becoming less niche, like rare earth bottlenecks and things like that. But basically, that general trend, like let's say over the past 25 years, the things that are more labor or resource intensive have tended to gone up in price faster, whereas things that we've gotten exponentially better at making, grains, textiles, electronics, plastic toys, and stuff like that, that generally is either not keeping up with the money supply or in some cases outright deflating in price because the productivity growth has exceeded the money supply growth.
Well, I think the Keynesians, a lot of them, the hardcore ones, like the labor economists and a lot of these deflationistas, there's some of them out there, Lynn. I don't know if you've seen it, but some of them said there's no evidence of any inflation for many, many years. It's just kind of shocking. Look at the asset price inflation. A lot of my bills, the everyday necessities, are up a lot, enormously over the years. But I think you talked about aggregates. I think aggregates. I think one of the main mistakes that a lot of these Keynesians make is they say, well, the money supply is up this, but all the prices aren't up a uniformly amount like 6% or something. Therefore, there's evidence that there is no inflation. Or they cite like something like, oh, the mountain bike prices are falling. Therefore, there's evidence of no inflation. But when you have all these distortions and central planning like this, and the government's giving out bailouts or subsidies or unbidden contracts, I mean, it just creates enormous distortions throughout the economy where certain prices can go up. Look what happened with some of these shares of certain companies or prices for certain items. The government decides it wants to hoard certain key strategic metals. You could have stuff like that. So like consumer staple item stuff, you have to just to survive. Those items seem to be going up in price enormously over time. And now it seems like lately with the Fed raising interest rates the last couple of years, credit problems, the economy slowing down, people are losing their jobs with artificial intelligence, software, or outsourcing, that the discretionary items now that people easily could have afforded maybe in the past, they're either stopping buying them or they're potentially defaulting on them, what we're seeing now with subprime auto.
Yeah, I would say if someone argues that there's no price inflation, I invite them to hold bonds. If that's what they
Well,
want to
if
do.
they probably have held bonds,
Yeah,
Lynn, for the last 4 or 5 years, and they might be out
and
of a job. So,
and that's rough. Yeah. So I mean, I've been having this debate with some uh, friends that are on more the deflationist camp, and many of them were arguing for bonds and against other types of assets, and things the chips fell where they did. Now it doesn't mean that bonds can't be a decent trade from time to time, but basically. bonds will buy you a lot less of most things. Now, in the deflationist credit, I mean, certain things like, it's oil, like oil, for example, as I already mentioned, is pretty cheap. That's a pretty fundamental component to high inflation most of the time. Obviously there are pockets of weakness, but that's why in a K-shaped recovery, people can often cherry pick the thing they want to focus on. But at the end of the day, it depends on their job description. I mean, are they making returns? Are they not making returns? Are their calls working? Are their calls not working? Are they kind of growing
Well,
in share of things, or are they kind of stagnating and shrinking?
Well, also, Lynn, free market capitalism, over the long term, if there's competition, if governments aren't putting trade barriers up and extra taxes and tariffs and subsidizing this industry or blocking that industry, picking out winners and losers, capitalism produces through competition, innovation, it produces beneficial deflation for the consumer. Look at how much cheaper quality TVs are, how much cheaper what nice computers, those things are cheaper. That's from beneficial deflation and competition. But it just seems to me the last, especially with Trump coming in, I mean, he started this trade war. He's putting up trade barriers now. He's trying to force prices from not falling in certain industries.
Yeah, I mean, I've been on the record of not being very bullish on the effectiveness of tariffs. I mean, there are certain contexts where if you replace part of an income tax with a tariff in some sort of sensible way, that could be a tool in the tool chest. But the way that this has been done, it's primarily been a tax on, to some extent, on corporations, and to a lesser extent on consumers. Now, if the tariffs stay in place, I do expect those companies to increasingly pass on a greater share of those increases to consumers. It also has added a lot of business uncertainty. It's very hard to plan when you have kind of very mercurial policy changes happening around you. A lot of headline risk all the time when you're trying to make kind of these long, like, 5, 10, 15-year capital allocation decisions that you need a kind of a long forward expected return on investment when making that decision. The manufacturing PMIs are still weak. And so, people can talk about reshoring things, and, there's always individual things being, individual manufacturing facilities being built, individual things happening. When we look at the aggregates, it's pretty weak. But I think we're in kind of, when you have fiscal dominance, it often gets the case where everything that could be tried gets tried. So if they find themselves spending too much, unable to raise taxes, it's very unpopular to do so for obvious reasons. I think it's not surprising that they say, well, let's try to tax the foreign sector. Let's try to do tax increases that are hard for people to kind of realize are potentially hitting them. And see to what extent that works. And so it generally takes months and years to sort this out. I mean, earlier this year, one of the big headlines was Doge. That we're going to slash massive amounts of government spending was kind of the headline stuff. Sam Callahan and I released a report on my site back in January, kind of outlining pretty much step by step why that was not going to happen. And overall spending this year ended up being higher than last year. There's very minimal cuts. They kept kind of pointing to all these like optical things. They were kind of doing interesting accounting to try to say how much they were cutting. But at the end of the day, while they gutted a few kind of smaller little tiny slices of the pie chart, they didn't actually make a dent in the overall spending pie. And
It's
so
under
yeah,
200 billion, right? So I think the actual estimates are under 200 billion and what they're aiming for 2 trillion or something like that.
yeah, and when you look back and you say, okay, well, I mean, as the dust settles, it was what it was, and I think we still need longer to play out with tariffs, but then it's kind of like, well, it was what it was, and so right now, consumer sentiment is near record lows. Stock market is at all-time highs. Stock market is doing poorly in gold terms, which is generally a sign of stagflation. Like it's not generally considered a booming stock market when you're underperforming gold, even though there's much worse things to be in than the stock market right now. And you have just gradually weakening labor market, and it's a challenging kind of place to be operating in. It's not just the current mix of policies, but it's kind of a lot of policies that led to this point as well.
And a lot of the policies, the mix of it's a weird mix of stuff. It reminds me of reading about like Herbert Hoover, and then FDR doubled down on it. Congress was doing similar stuff. It was a weird mix of subsidies, bailouts, and tariffs. The issue now, Lynn, with the size of the budget deficits, how quickly the national debt is growing. I think we're adding $1 trillion now every 80 days. Last year it was 100 days. The issue now is, Trump with the trade wars, and before he gets all these trade deals finalized, he goes for ridiculous, talking about 50, 100% tariffs first, and then he wants to negotiate it down. I see. But then if you're a BRICS country, non G7, what incentive do you have to hold US Treasury bonds or buy more new US Treasury bonds?
Well, for the most part, you don't, and so there's not been a lot of, especially foreign official accumulation of treasuries. There's still been some private sector interest. As far as the amount of deficits, one thing we have to be careful of is things that happen in 80 days. It's not a smooth treasury growth throughout the year. So the past couple months has seen the treasury refilling its cash account from very low kind of debt ceiling levels all the way up to their kind of target level. And so I wouldn't extrapolate that all year. Similarly, for example, when tax season comes around, that tends to be a low quarter of deficits. So there tend to be higher deficits in the back half of the year, which we're in now. So we're still running something in the ballpark of $2 trillion deficits, which are large, but they're not really accelerating at the moment. That combination of some tariff revenue combined with interest expenses that, at least the Fed is no longer raising rates. So some of that is starting to settle out, and we're kind of in this choppy, not really accelerating, but still high deficit environment.
So, in public, I hear Trump like it's back and forth whether he wants a strong dollar or weak dollar. Because I've heard Bessent talk about that they wanted a weaker dollar. I think months ago, that was part of their policy. Do you think that the administration they want a weaker dollar, and do you think that they also want higher gold and Bitcoin prices for different reasons?
So if you look at Stephen Mirren published a report back in November 2024, right after Trump's election, and it was how to restructure global trade. And then, of course, he became Trump's chief economist. Now he's on the Fed, and so that's kind of like the steelman argument for what they're trying to do. That's kind of the more like academic treatment of this administration's kind of tariff and dollar policy. And what Mirren kind of pointed out in that paper is that their expectation was that as they play hardball in the beginning, so as they kind of threaten tariffs and start from what they view as a strong negotiating position, that it would probably result in a rising dollar. And then as they make trade deals, they could include something like a Mar-a-Lago Accord to then, purposely weaken the dollar after having locked in deals that are favorable to the U.S. That was kind of the high level game plan. And it didn't really work out like that. So as they played hardball with tariffs, they got a weaker dollar. Bessent did argue earlier that a strong dollar would push down inflation despite the tariffs, but then we got a weaker dollar. So they have in some cases tried to have it both ways. Trump has at times he's done some of these interviews, like it was a couple of years ago with Bloomberg. I think it was actually less than a year ago, where he pretty articulately described how certain other currencies were undervalued relative to the dollar, and that, for example, like Komatsu's like heavy equipment was at like an advantage compared to Caterpillar. Like he was actually making something that sounded like a macro researcher was saying that. But at other times, he's argued for a strong dollar, in part because Trump's optics are around strength. So generally, they don't want to say out loud, we want a weaker dollar per se. They'll usually use phrases like, we want, other currencies to trade at their fair value. We want other countries to stop doing currency manipulation, which generally means that they want those currencies to rise in strength relative to the dollar. So I think the problem is that they have conflicting goals. So they want low inflation, they want a strong economy, but then they also want to reduce the trade deficit, and they want to keep the dollar as the global reserve currency. The problem is that the way the world gets dollars to use the dollar as a global reserve currency is primarily through our structural trade deficits with the rest of the world. So that's the cost we pay for that. And because of the fact they want to have their cake and eat it too, um, they have conflicting goals, and therefore they have these conflicting statements about the dollar because there's no like they can't just lay out like a three step policy thing that makes sense for all those goals. So in any given topic, when you ask them something, you're going to get one answer versus another answer. And someone like Scott Bessent, of course, is very intelligent. He'll be able to put together something that at least sounds somewhat cohesive. But when you can still pick it apart is the problem. And it's just because in engineering, like let's say you have fast, cheap, or good. The kind of the joke is you can pick two. You can't pick all three. And that's kind of the policy mix right now is like out of all those things I listed, you can pick maybe two-thirds of them. You can't pick all of them. And they've not been able to let go of the one-third that they want to let go. So
Well,
that's
they
the
also
problem.
can't expect China, Russia, and the other BRICS countries to go along with everything they say easily. So, what I'm seeing now, I don't know if you read the book Currency Wars by Jim Rickers, where in the first chapter of the book, and I highly recommend our listeners go and reread the book or read the book for the first time. It's cheap now because it came out, I think, in 2010 or 2011. There's a financial war game scenario. And in the financial war game scenario, I think the US is like threatening all these trade tariffs and trade wars and all this other stuff. And the other countries are like, you know what? We don't want to buy treasuries anymore. We're just going to start buying gold. So a lot of the stuff that has happened the last three and a half years with the Russia sanctions, the 300 billion of Russian reserve assets that were confiscated, the interest payments from Russia on their treasury bonds that were taken as well by the US. A lot of it seems to be playing out very similar to the financial war game scenario in that first chapter of the currency wars, where Russia and China and the other BRICS countries just decide they're tired of dealing with all these crazy, Looney Tunes, Yosemite Sam type policies out of DC.
Yeah, no, I think that's right. I think the part where I would defend the current administration is that I do think that for years now, American politicians have underappreciated the importance of the structural trade deficit. It's just not been something that comes up almost ever. And it has been a structural issue because it's tied to our global reserve currency. And so I do think that it was correct to elevate that as an issue. I just think that the policy mix hasn't been particularly coherent. And an issue is that I think that the US has not as strong of a hand as many people assumed. Um, and so that's the issue is basically I think somewhat correct diagnosis, but then not the correct execution is how I would describe it.
Yeah, to add to your points there, from what I've heard in some of these trade deal negotiations, they've actually tried to get some of these trading partners in trade deals to agree to buy treasury bonds, and these other countries have refused. So take it. I haven't seen an announcement saying that that's 100% the case, that that's exactly, but that's what I've heard like off the record from sources here.
I mean, the key issue here, right, is that connection between the dollar as the global reserve currency and the trade deficits. And for, let's say during the Cold War, maybe it was the case that having the global reserve currency was very important. It allowed basically, the Soviet Union had to get oil the hard way, whereas the United States could just print money and buy it more or less. And that was a really big strategic advantage. The problem is when you run that playbook for decades. So after, and Luke Roman's made this point a number of times, is after the Cold War ended, the monetary system could have been restructured to be more balanced, but it wasn't. So the whole world uses the dollar ledger, which means the whole world needs dollars, which means we send dollars out into the world. They overvalue our dollar. It boosts our import power. It hurts our export competitiveness for lower margin things, which is primarily manufacturing. And so we hollow ourselves out. We flood the whole world with dollars so they can use it as the global reserve currency. I think the correct approach here would be to pull back gracefully. When an empire gets overextended and it's no longer benefiting from being an empire, its borders are too big to defend properly. There's trouble at home, and all that. The correct move is to basically retreat from a position of strength and focus on the core. And in that case, it would be saying, we're fine with, Asian countries using China's currency more. We're fine with a more multipolar currency world. We're fine with gold re-entering the system as kind of a global money. We're fine with Bitcoin being this store of value and open source settlement network. Basically, that we don't necessarily need 800 foreign military bases, um, and you kind of retreat tactfully from that position of strength. And then say we're going to focus on the robustness of our domestic economy and having really good trade relations with our neighbors and kind of focusing on making sure our energy policy is great and then trying to reshore some stuff in exchange for giving up some of that kind of unilateral ability to sanction anyone in the world. But the problem with almost all empires is they never do pull back from a position of strength. They instead fight for every little border they have. They fight with all their blood and treasure until they lose it, not from a position of strength, but from a position of weakness.
I asked you a second part of question a couple of minutes ago. You talked about the weaker dollar and their stance, and it's like one thing in public, one thing in private, back and forth. The markets aren't, they produced a weaker dollar. The other part of this is, do you think that the Trump administration, do you think that they want higher gold prices, that maybe they were in there buying some gold earlier this year, maybe to get the dollar down, and they would have denied this? And do you think that long term that they have a strategy where they're going to adapt? They think that the U.S. economy can flourish, that DC can be all right financially with its finances at higher gold prices, at higher Bitcoin prices?
So I'm not sure if they directly participated in gold going higher. Scott Bessent did give comments recently that were pretty favorable on gold, and obviously the administration's taken a more favorable view on Bitcoin than the prior administration did. So I think at least at the bare minimum, I think they are fine with higher prices. Um, you can ask geopolitical strategists or those that are kind of closely tied in with the administration what individuals may think about it. But I think in general that they're fine with those higher prices. I think that they, to some extent, if you just see gold run away, I think, there are people in administration and within the Fed that would be concerned about that because it would, generally show a lack of confidence. If you have gold just trouncing treasury bonds year after year after year, that can start to become a problem if you still want the dollar as the global reserve currency, which this administration ostensibly does. But I think for how cheap gold was, I don't think a doubling of it, which is basically what happened from to call it 2,000 to 4,000 an ounce, I don't think that poses a problem at all for the United States. They do have supposedly significant gold reserves. They do have that mechanism that's right in the Fed handbook where they can revalue their gold holdings up to basically whatever price they want. They can obviously the easiest one is just to jump to current market value, but they technically can also do open market operations and jump gold even higher. And that's one of the few ways that they can spend without issuing debt. So if they did want to do some sort of intentional debt devaluation, then higher gold prices are beneficial. So, I kind of view the administration as neutral to positive on gold and Bitcoin, at least up to certain levels.
Yeah, I agree. Judy Shelton, what is an advisor, and she has a book out about this, about gold-backed treasury bonds and having a higher gold price. Also, Jim Rickards, I think about 6 or 7 years ago, he put out a smaller book called The New Case for Gold, and it was talking about why the U.S. government would try everything else, basically a lot of the stuff over the last 50 or 20 years, and then eventually decide that they wanted a weaker dollar and that they would start buying gold and move the gold price to a certain level. Now, not, runaway prices like you said, but move it to, I don't know, $4 or $5, $6,000, get the dollar weaker, and then manage the gold price that way. And then that would allow the US's asset side of the balance sheet with the gold holdings to be worth way over $1 trillion.
Yeah, I think that'd be the smart mechanism. I think doing open market operations earlier to get more official gold on the balance sheet would have been useful. Um, my guess is that this just kind of happened without them. They might not have fought it, or they wouldn't really have a good reason to fight it. And I think if I go back to my point around empires, basically one of the ways of that playing that long game of kind of retreating from a position of strength is to let gold and to some extent Bitcoin go higher to have these neutral reserve assets. Because basically, the way to rebalance the global monetary system is to not have any one country's ledger be the primary liquid savings of all the other countries, because that overvalues their currency and affects their trade balance because they have to flood the rest of the world with units of that currency. And instead, for the primary liquid savings asset to be some neutral money. And so historically, I mean, the biggest one is gold with something like a 27 trillion market cap. Bitcoin is like the 17-year-old up and comer that's like a 2 trillion market cap. But assets like that, or a kind of a mix of multiple countries' currencies and bonds, is a more balanced way to do things. Now, because of network effects, this is not always intentional. And so, when a money becomes larger and more liquid, that begets more liquidity. It's self-reinforcing. And so the dollar has had that kind of benefit and that curse for a long time, until basically the cost started to catch up with it. And so, but yeah, I think that a smart move, and I don't know to what extent they are doing it, but I think a smart move is to support gold and Bitcoin and going up in price, or at least like not get in the way and say, sure, we want a more multipolar and decentralized global store of value and payment system.
Well, it seems, according to estimates, that the Trump family's made billions of dollars extra in the last 3 to 5 years, mostly off of crypto. What Eric Trump just launched, a new competing to Tether, a new stablecoin. I think that's publicly traded on the Nasdaq. Do you think the goal from the Trump administration, the US Treasury Department, is for higher Bitcoin prices? So then there's more demand for stablecoin, and then stablecoin will buy more US Treasuries?
Well, there's a couple of questions there. One is I obviously I do think that they want their bags higher. That is, I think, true. And then as far as the stablecoin policy, yeah, I do think that they are viewing stablecoins as a potential demand source for treasuries. They pretty much said it outright. I mean, Secretary Bessent has said it outright. Some of them have cited the Citi report. So Citi released a report earlier this year, and they outlined a bear, base, and bull case for stablecoin demand, I believe through 2030. And Bessent cited the bull case, which I think was 3.7 trillion of stablecoin demand by that time. The base case was much lower at like 1 point something trillion, and the bear case was lower than that. So basically, what Citi did was they looked at all the different types of usage for demand sources for dollars. So it could be money markets, it could be domestic bank accounts, it could be foreign dollar-denominated bank accounts. It could be domestic holding of currency. It could be foreign holding of currency. They kind of looked at all these categories, and they said, to what extent is it reasonable to expect stablecoin to take market share? And then for their bear, base, and bull cases, they assumed, higher rates of stablecoin taking market share from those different categories, and they got up to those figures. Now, it's important to point out that just because let's say you add $1 trillion in new stablecoins, which would be quite a bit, because right now there's only, a few hundred billion in stablecoin market cap. Let's say you add $1 trillion over the next 5 years. That's not entirely new dollar and treasury demand, because that is partially coming from existing sources of dollar and treasury demand. That's coming from money markets. That's coming from demand for bank accounts. That's coming for foreign dollar bank accounts. And so partially what you're doing is you're converting a fractional reserve to what is ostensibly a full reserve. So a stablecoin is ostensibly backed primarily by treasuries. For a while, there was also reverse repos, these kind of lower risk types of collateral, whereas banks are, a bank deposit is backed partially by treasuries, but then also by a bunch of other loans and things like that. And so what that does is on net increase treasuries, but it's only a percentage of that headline amount. And then you have to look at magnitude. So let's say we do add $1 trillion in stablecoin market cap, and let's say half of that represents entirely new demand for treasuries. Let's say, half $1 trillion. If we're running $2 trillion deficits a year, that's 10 trillion in deficits over that 5-year period, of which stablecoins might have absorbed half a trillion. Um, and so,
Could you talk about how stablecoin, the demand and what they buy, how it increases when, say, let's say Bitcoin goes to 200,000, 250, 300,000? How much more assets under management would stablecoin have? So would they be buying hundreds of billions more then? Would they have a lot more access to capital and liquidity, assets under management if Bitcoin goes, let's say, to 300,000 or 500, somewhere a lot higher then?
well, it depends. So, one of the first use cases of stablecoins was as a trading unit of account in offshore exchanges. So, as Bitcoin got bigger, stablecoin balances got bigger too because people were flipping back and forth between Bitcoin and stablecoins. Now it's the case that institutions and other kind of like not like onshore type of things are kind of the principal sources of demand for Bitcoin. It's less correlated with stablecoins. Um, the large holders of Bitcoins, like MicroStrategy, for example, have almost nothing to do with stablecoins. Now, some of the biggest stablecoin issuer, Tether, they do take some of their profits and put them into Bitcoin. And so, to the extent that the Bitcoin goes up, it strengthens their balance sheet. To the extent that the stablecoin market grows, and if they continue their investment plan, they can invest more of their profits into Bitcoin at an accelerating rate. Um, but for the most part, they're somewhat separate markets. Other than of course that if trading volumes go up, you generally get some degree of intercorrelation. But I would say they're at this point they're pretty different demand sources. And part of the reason why Tether has grown faster than Circle is because like a lot of the Circle stable coins were used in things like DeFi, whereas Tether is actually often used in the emerging world.
And now Tether, what is buying physical gold? They're buying gold mining stocks. They're buying royalty shares. I'm just kind of scratching my head at some of the press releases that are coming out. They're buying like 10% equity stakes in some of these gold mining companies and precious metal royalty and streaming companies.
Yeah, I mean Tether has a very large balance sheet. I haven't closely followed their latest investment decisions. I used to follow it more closely. But yeah, when they have all this interest income from their holdings, they are investing in a lot of different companies. They're also, yeah, they're active in venture to varying degrees. They're active in all sorts of things.
So you're saying that there's not a 100%, like a almost a pure 100% correlation one to one. Then say if the Trump administration thinks that Bitcoin price is going up to 300,000, then that creates the 3 trillion bull case for treasury demand that Scott Bessent is talking about, that he cited the research report that prop won't necessarily happen even if Bitcoin does go to a lot higher price.
Yeah, I think they're mostly separate markets at this point. I think that basically stablecoin increases are primarily demand for dollars and treasuries. Now, I happen to be of the view that over the next several years, I think both of those things are going to go up and to the right. So I think Bitcoin price is going to go up, and therefore the market cap is going to increase. And I also think that the amount of stablecoins is going to go up by at least several hundred billion. Perhaps some of these higher numbers. So I happen to be bullish on the market caps of both assets, but I view the reasons as somewhat different. Now, I guess the part that they share in common is that as more and more people understand those two assets, if you're in Egypt and you're holding Egyptian pounds and the Egyptian money supply is growing faster than the growth rate of dollars and it's growing faster than the growth rate of gold or Bitcoin. Historically, Egyptians do invest in gold, and sometimes they'll buy dollars on like the black markets of Cairo. But if they can do it from their smartphone and they can buy Bitcoin or they can buy stable coins, or in some cases they might be able to buy interest-bearing stable coins, basically passing on some of the treasury interest to the holders. Um, as more and more people around the world, billions of people learn to do that, and as the tools get easier to use, that is one of the things that they perhaps do have in common, Bitcoin and stable coins, is that they both represent alternative liquid things that people around the world can put their money in. And of course, the key difference is that Bitcoin is decentralized, Bitcoin is scarce, but Bitcoin is volatile. And so it's generally more suitable for longer term holding. Whereas stable coins, they get debased, they can be frozen. They ultimately are the dollar, often without interest. But they're useful for working capital, especially if your alternative is another weaker currency. So that's what they have in common.
Well, Bitcoin prices are also heavily correlated with the Nasdaq 100, so they're more of a risk-on speculative asset.
Yeah, so Bitcoin generally correlates with liquidity. Multiple assets do. Now, prior to COVID, there was less correlation between Bitcoin and the Nasdaq because liquidity on average was less of a factor back then. There were these fiscal and monetary forces were just not quite as big in the second half of the 2010s as they were so far in the first half of the 2020s. And so a lot of things move with liquidity. And Bitcoin is generally no exception. Gold, being a more defensive asset, has a more mixed correlation with liquidity because it is more of that risk-off asset. And I think Bitcoin is going to remain, it's often going to be traded as a risk-on asset until it's much larger than it is now.
Well, also, I mean, there's a lot more institutional ownership. What for many, many years, over a decade, it was very tough for any institution to get any ownership of Bitcoin. I mean, there was a lot of pension fund boards, they couldn't get any approval to even buy a single Bitcoin. I know hedge fund managers that couldn't buy any Bitcoins with any client funds. So personally, they were buying Bitcoin. They're trying it out, they're buying it, but with their own shareholder, with their own investor money that they were managing professionally, they couldn't buy any.
Yeah, and that's I mean the this cycle has been primarily defined by corporations and other types of pools of capital buying now that it's easier to do. So this obviously the spot ETFs added to that. The FASB accounting changes made it less detrimental tax in terms of accounting treatment. I mean, to hold Bitcoin on your balance sheet. Just the asset became large and liquid enough for institutions to have it on their radar. I mean, when it was a $50 billion asset, nobody cared at that scale. Once it's over a trillion and stays there, they care. Um, some even sovereigns get involved, and so it's natural that this cycle is driven more by them. So far, most indicators show that retail investors are not particularly participating in this cycle, uh, either in Bitcoin or in broader crypto. I think the broader crypto space, which many people know I'm less favorable on than I am on compared to what my views on Bitcoin and stablecoins. I think the broader crypto space has burned a lot of retail investors and speculators. And then also, I do think that some of the two-speed economy aspects that we talked about, um, there's lots of retail investors that just don't have the capital to buy a ton of Bitcoin. And so those that do are often the wealthier, the corporate, the bigger balance sheets that are out there at the current time.
A couple more questions before I let you go. So it seems that quantitative tightening is ending. They haven't restarted QE officially. Do you think we're going to have to see maybe like Jeffries Bank, some other type of credit event, or additional problems in the repo market, where maybe like a large hedge fund or a sizable bank that has borrowed in repo to put on leverage trades or other loan books or other derivatives bets or other stuff, they have a counterparty fail, and then the Fed steps in similar to 2019. Do you think that in the not too distant future, over the next 6 to 12 months, we're going to see something like that, and that's going to do a 180 on the Fed's official balance sheet?
Well, we could have counterparty fails for any number of reasons. I think the path with the Fed's balance sheet is going to be that they're very close to stopping quantitative tightening. Basically, they compared to the repo spike of 2019. This time they have a standing repo facility in place. And sometimes at quarter end, due to window dressing, that's been used. To take out the jargon, basically, say banks and other financial institutions, they want to make the last day of their quarter, their balance sheet look good because that's the snapshot that's going to be on their quarterly report. So they'll generally do various kind of liquidity actions to do that. So there's kind of a little bit of a rush for liquidity at the last day of a quarter. Um, so there has been some usage of the facility during those quarter end periods. What makes the last month interesting is that in mid-September, and then again here in October, there's been usage of the standing repo facility even outside of a quarter end. even outside of, the end of September, which was the quarter end. And so that shows that there's more stress in the system. There's more kind of liquidity shortages. Now, the Fed actually predicted this. New York Fed released a paper saying that they think that the transition of around 12 to 13% bank cash as a percentage of bank assets aggregate is the transition point between abundant reserves and ample reserves. And that's where they're at now. So as they've kind of reached that level, they started to get these little liquidity strains. In addition, the New York Fed's been releasing these annual reports saying that they expect the Fed balance sheet will decrease until late 2025 or 2026. And then it'll gradually start increasing in line with nominal GDP. And that's what I expect to happen. I think that basically they're going to stop QT. And then after some months, if repo facility is continuing, they will probably go back to a period of gradual balance sheet increases. So not some sort of very rapid, giga stimulus, but just a more mild one, unless there's a separate event apart from what I'm talking about now. But just looking at these liquidity constraints, I think we'll see a gradually rising balance sheet. Which was actually similar to the repo spike, except the fact that I think it'll be more smooth than that. So kind of not the type of stimulus we saw during COVID. Um, and the challenging thing there, of course, is that in some ways that cedes the size of the balance sheet over to the fiscal side, because very large fiscal deficits can cause liquidity issues, and the Fed will basically be putting out liquidity issues by expanding their balance sheet. Um, and so I think we'll be in a kind of a new era. I mean, the past 3 years have been quantitative tightening, and I think that's coming to an end, and we'll see a gradual increase. Now, I also think, I mean, and the Fed's basically forecasted this, is that they will continue to let mortgage-backed securities mature off of their balance sheet, even as they go toward um, reaccumulation of T-bills.
Okay, well, that's the plan as of now. We'll see what happens if things get worse with Jeffries Bank because what Jeffries Bank, I think they've been borrowing from the Fed's discount window. There's at least quite a few banks that have been borrowing from the Fed's discount window. That's emergency. So normally banks or other financial institutions do not borrow from the Fed's discount window because that information becomes public, right? And then the short sellers know, and then they start attacking the shares of that company.
Yeah, so we'll see what happens. I mean, there's always individual banks that have issues. What I'm saying there is I'm looking at kind of aggregate liquidity across the system, kind of like how back in March 2023, there were specific banks that had these very unique characteristics that got in major trouble, and some of them went under. What they had in common, the ones that went under generally had a high ratio of uninsured deposits. So that's either business deposits or high net worth individual deposits that were way above the FDIC limit. So those types of depositors are more flighty because they don't have reason to believe that their deposits are insured. And they also generally had rapid deposit growth in the preceding years, and then they invested it heavily into like long duration treasuries and mortgage-backed securities. And so that combination of when rates went up really quickly and treasuries went down catastrophically, that our deflationary friends were holding. And so some of those banks were underwater, and then they got rug pulled by the depositors. Now, most banks back then were fine, but the handful of banks that were uniquely exposed were indeed in trouble. So the Fed, there were banks that went under, but then the Fed was able to continue what they were doing. So I think that again here there might be some specific banks that are in trouble. There generally always are, especially at any sort of pivot or turning point. But I think that the overall balance sheet will generally be slowing down its shrinkage pretty soon, and then in the months that follow, pretty gradually increasing. It would take, I think, a pretty big shock to have something that deviates from that and maybe cause it to go up more quickly.
For the listeners out there who didn't pay attention to this over the last couple of years, Lyn's describing what happened with the Silicon Valley Bank, and that was actually the first case we've ever seen of a digital bank run because people could literally pull out millions of dollars from their bank account with their phones. And so, like the FDIC, Silicon Valley Bank, the depositors moving massive amounts of funds, many, many billions of dollars, because there were people worth millions of dollars, Hollywood celebrities, Silicon Valley people pulling millions of dollars out very, very quickly that amounted to billions of dollars in aggregate. It just destroyed their ability to manage the bank.
Yep.
Yeah, so we saw like a bank run. It occurred what in the span of a couple days, just an insanely quick bank run, and it was all digital. There wasn't, the old bank run from the 20s or 30s or 40s where people were standing out in line to get their money back. It was nothing like that.
Yeah, that's one of the cases for higher reserves. So before the global financial crisis, U.S. banks on average had only 3% of their assets in cash, including reserves, which is a very tiny sliver of even that. And whereas now, banks have something like 13% of their assets in cash, which gives them a little bit more of a buffer for when they get these types of runs. And of course, if there's another problem with a bank, then a 13% buffer won't be sufficient. But in general, banks are more liquid than they were because they were extremely levered going into the global financial crisis.
Well,
Um, yeah,
Well, there's a problem with fractional reserve banking in general. What in
yeah.
2008, some of the banks got levered to. I think Lehman Brothers was what 60 to 1, and Bear Stearns was 80 to 1. I think Citibank at one point in 2008 or 2009 was leveraged 100 to 1. So they just it was absolutely insane the leverage ratio some of these banks got to, and they were basically insolvent, and they changed the accounting rules. So I don't know if things are as bad now. I think in Europe it's bad from what I'm hearing with the French government debt, but I mean there is obviously private credit problems, what 300 billion at least, and then there's the derivatives tied to that. So the private credit markets, the subprime auto loans, that seems like, and commercial real estate seem like huge, huge problems here in the U.S. But then there's problems in Europe too with French government debt and whatever's tied to that.
Yeah, I have concern around France. I think what I would describe is that in the US, so private credit and private equity, I think that's mostly going to be bad for the investors in those funds. I expect that the spillover of the damage that happens there will be pretty low into the US banking sector. That's not to say that there won't be maybe individual banks caught out. I mean, there's thousands of banks. There's always a bank in a headline failing. Um, but I think that will be fairly contained for U.S. banks. I do, however, have more concerns around the French financial system. I think that's, if I were to list one of the problem areas globally, I think France financially is one of those key problem areas.
Oh yeah, I agree. And whoever is holding that French government debt, because there's going to be huge problems with that. I don't know if it's going to get restructured, the derivatives that are tied to it. I think even in Germany, Lynn, they're trying to dump now the German banks and some of the private equity firms. They're trying to dump some of those bad investments, that toxic sausage, onto retail investors. And I think I just saw that recently. So that's like total desperation.
Yeah, I haven't followed that closely, but I wouldn't be surprised.
So last question here. I'm literally getting like messages from trolls that like oil demand is dead, fossil fuels are over. Why don't you start interviewing wind and solar and battery experts? What is your position? Because from a sentiment standpoint, I mean, for oil and natural gas, I mean, for natural gas, I see a clear demand picture. For oil, I mean, we're close to the marginal cost of production here. The sentiment is really, really bearish. Do you think risk reward is starting to look good for oil companies?
I think it looks decent. The sector has been more bearish than my expectations. So, while like say the gold part of my portfolio has done better than I expected, the oil producer and services companies have done worse than I expected. Now the fact that, you know, PMIs, so manufacturing PMIs, for example, have been in this slump for like an unprecedented amount of time because we have this kind of awkward fiscally dominant environment where the Fed is trying to be tight, trying to slow down the private sector while these fiscal deficits pour in. U.S. industrial production's pretty flat. Europe is deindustrializing, uh, um, and so there's not a huge uptick in global demand for oil and supply. While there are constraints in sight. I mean, as like shale is not particularly profitable to aggressively drill at the moment. Supply is kind of very gradually looking to roll over. Um, there are kind of these longer term constraints that are forming, which I do think will eventually result in bullishness. It's just the case that at this time, given all the uncertainty around the trade war, given China's kind of ongoing excess capacity and disinflation, given weak manufacturing activity in the US and elsewhere, uh, the overall kind of demand from energy intensive industries in most countries, or at least a lot of the big countries, is not particularly high at the moment. So when you have kind of lackluster demand and then okay enough supply, we have this kind of really middling weak price range. And so I think the deciding factor is that shale's not really sustainable for the long term at current prices. And so I think that that will kind of reset until it starts to constrain supply and push the cost up. I do think that the world will be using all forms of hydrocarbon, including oil, in large amounts for many, many decades to come.
Yeah, I think the supply demand picture for natural gas, liquefied natural gas, nuclear power, uranium is very, very different because it's tied to the data centers.
Yeah.
If Bitcoin goes to a higher price, you're going to need more electricity for Bitcoin mining. But especially these data centers, I mean, I'm just seeing tons of articles. I know there's a lot of people that think like AI is a full bubble, it's not useful at all. The companies are spending the money here in the United States, Canada, Europe. They're building the data centers out. I mean, there's only a couple large data centers that are actually online. Most of the stuff's still under construction or waiting in the queue. You only have a couple large data centers from Colossus XAI. The XAI Colossus data center, in Tennessee and Mississippi, and then the one in Texas, Stargate one from OpenAI and Oracle and the other large companies. So there's only a couple large ones online right now. Those data centers get built, they're all next to natural gas facilities.
Yeah, and markets seek arbitrages. So it's long been the case that with cheap North American natural gas, and that's because natural gas is not very fungible, even compared to oil. And so it's been the case that natural gas has been less expensive in North America than elsewhere. And if you look at the energy component of natural gas compared to oil, it's much cheaper on an energy basis. And so there's various incentives to try to find ways to use that natural gas more so than the oil. And so as data centers and other sources of demand have risen, they've primarily been going after natural gas, which makes a lot of sense. And that build out will continue until it'll kind of reach like its kind of temporary capacity. Probably some of it get washed out, and then we'll maybe have another leg higher.
Yeah, so this is the issue. Like the people that are saying AI is a full bubble. I mean, like people said the internet was a bubble, and yes, there was a lot of unprofitable companies. Yes, a lot of these like pets.com and some of these other ones, the shares went up. It was solely on what speculators. There was no actual business there. But then after the internet bubble collapsed, look at all the other companies that came to fruition with Amazon and Google and so many of the other ones. So the money was invested. Yes, it wasn't invested efficiently, but eventually, there was a ton of innovation and stuff like that. I think we're going to see similar stuff over the long term for artificial intelligence, data centers, and robotics.
I agree.
Well, thank you so much for your time today. I won't ask you where you think the gold price is going to go. I mean, because it's gone up a lot faster than I thought it would. It was at or near an all-time high in every other currency but the US dollar, way ahead of time. So I was expecting a move up in the US dollar gold price, but it's gone up. It was overdue for a correction, though.
Yeah, I agree. I think the way I've been phrasing it is that I think that gold itself is still not overvalued. Um, when you look at, say, its percentage of the kind of global liquid savings market, it's still pretty reasonable. But it is tactically very overbought. It's like the highest monthly RSI in modern history. It's very enthused in that sense. And so I do think it's probably due for a breather. Now I don't try to make like 3 month predictions about anything. I mean, I don't try to stand in the way of a huge momentum. Um, Now that might have been broken recently, that momentum. But yeah, I don't have any view on the next 3 months other than I do view this as a period of heightened risk for gold. Um, and I track sentiment on social media. Like there are cases where Bitcoin is soaring and gold is flat, and Bitcoiners are dunking on gold enthusiasts. And this has been the inverse, where gold's soaring, Bitcoin is kind of stuck at its little chopping over 100K, which is nothing to sneeze at. But gold enthusiasts are having their victory laps. I own both, but I see the sentiment pretty clearly across social media. And I mean, if I had to pick one for the next 12 months. I would say Bitcoin. Obviously, nothing is assured, but I'm long both.
Well, I mean, the central banks, the non-G7, the BRICS, and non-G7 central banks will keep dollar cost averaging gold. Now, I don't know if that's going to cause a huge spike, but it's going to be a steady source of demand. So that's what's been occurring the last 3.5 years. For the people, there's a lot of people in the mainstream financial industry, and they've been calling top for gold at 2,000, 2,500, 3,000, all the way up. There's some people that have been calling a top in gold, every couple weeks. So they've been wrong all the time. I'm sure they're deleting all their social media posts, and now they're going to say, finally, I called the top in gold, patting themselves on the back. Look how I nailed this call so perfectly. The top in gold is in. It'll never get as high as 4,100 ever again. So there's going to be those types of people. But I mean, long term, just go and look at a money supply growth chart. What on the St. Louis Fed's website, Lynn, from what M2 over the last like 20, 30 years. I mean, it's parabolic at a little dip over the last 3 years, and then it just keeps rocketing up. So as long as like these governments and central banks are going to monetize debt, the central banks are going to expand their balance sheet, the monetary inflation, the money supply is going to keep growing. There's going to be other people not looking to want to hold U.S. Treasuries long term and dollars because they're gonna wonder what the governments and the central banks are going to be doing with all the newly created currency.
Yep,
So
absolutely.
until that changes, until there's discipline, and I don't see any discipline in the current system, um, I think the trend is going to continue. Now, we will have corrections, we will have volatility. I don't see this trend going away. I mean, I think what DC did fundamentally with the policies, and then Trump added on to that with the tariff wars, giving these non-G7 countries less incentive to buy treasuries with all the threats, of the tariffs and the trade wars and the other stuff. But 3.5 years ago with the Russia sanctions, if you're a BRICS country and you had a good amount of tens of billions of dollars in treasures or more, and you saw what they did to Russia, I mean, I would want to be hedging my treasury position. And that's the comments you've seen from the central bankers, the Polish central banker and others. That's exactly what they've said publicly is, look, we can't fully trust either political party out of DC because, willy-nilly, they could just change their mind and go right after our holdings.
Yeah, I agree.
So, Lynn, please tell my listeners more about your book, Broken Money, and about your newsletter.
So Broken Money is my 2023 book on the history of money and monetary technology. We brought up the issues of fractional reserve banking. For example, the book discusses that, so people can check that out if they kind of want my holistic view of this whole thing. And then lynalden.com provides various free and low-cost paid research for investors and macro enthusiasts.